Imagine waking up one morning, you look at your bank account, and, well, the numbers are exactly the same. Yet somehow, you just know your money doesn't quite stretch as far as it did. It's this kind of creeping feeling, isn't it? Like a chunk of your hard-earned savings has just, poof, vanished. Not stolen, not misplaced, but silently eaten away by some invisible force. What if we told you this isn't some, dystopian story, but it's a reality a lot of people face? And crucially, there's a proven way to fight back, a way to turn this invisible enemy into, well, maybe your greatest ally for building wealth.
That's a really powerful image. It taps right into that core anxiety we all have about financial security, doesn't it? So many people grapple with these big questions, maybe without even realizing it. Like, how is it even possible that your money is losing value while it's just sitting there, supposedly safe in the bank? And what is the real fundamental difference between just, preserving your money by saving it and actually growing your wealth, making it multiply? And could the secret to not just surviving financially, but actually, thriving long term? Could it lie in some pretty simple, often overlooked principles that shift you from always working for your money to having your money work actively, relentlessly for you? These aren't just like abstract thoughts. They're the foundation of financial freedom, really.
Those are exactly the big questions we're tackling today on the deep dive. We're going deep into this silent, sneaky erosion of wealth that we call inflation. And more importantly, we're uncovering some powerful, actionable investment strategies. Strategies designed not just to protect what you have, your purchasing power, but to actually accelerate your financial future. Our mission today, it's to cut through all the jargon, maybe reveal some surprising facts that challenge what you thought you knew, and give you practical steps. We want to decode this often complex world of inflation and investment, basically hand you a clear roadmap so you can make really informed financial decisions.
Absolutely. And to help us navigate this, we're drawing on some really insightful source material today. We'll be looking closely at excerpts from Taming Inflation, Investment Strategies for Financial Growth, which comes from the Shark Trading Channel. They've done some exceptional work laying the groundwork here, offering a perspective that blends solid theory with, practical market wisdom. It's really good stuff.
Okay, let's get into it then. This invisible enemy, the one we mentioned right at the start, inflation. We hear about it all the time, right? News reports, economic updates, how it hits our grocery bills, gas prices. But for our listeners who probably follow these topics already, let's peel back another layer. Beyond just the basic definition, what are the actual mechanisms driving inflation? How does it really work in the economy?
Right. So at its core, inflation is that general sustained rise in prices, which means your currency buys less over time. That's the basics. But the mechanisms, as you say, are, well, they're varied. You often hear about demand pull inflation, basically too much money chasing too few goods, right? So
Yeah.
prices get pulled up. Or there's cost push inflation. That's when the costs for businesses go up. Think raw materials, wages, and they have to pass those costs on to us, the consumers. And then there's the money supply angle. If there's a big jump in the amount of money circulating, but not a similar jump in goods and services available, well, each dollar, each pound, each unit of currency just becomes less valuable. So it's not just things cost more, it's literally your money losing its inherent worth.
Okay, so it's not just sticker shock at the store, it's my actual money becoming fundamentally less valuable. Can you make that really concrete, like an everyday example that makes it click?
Definitely. Let's use that Egyptian pound example. It makes it very clear. Imagine you've got 100 EGP. And let's say potatoes cost 10 EGP per kilo. Okay, with your 100 EGP, you can buy a solid 10 kilograms of potatoes. Easy. Now, let's say a year goes by and there's 20% inflation, not hyperinflation, just 20%. Suddenly, that same kilo of potatoes isn't 10 EGP anymore, it's 12 EGP. So what happens to your 100 EGP note? It's still 100 EGP, the number hasn't changed. But now it only buys you about 8.3 kilograms of potatoes. You've lost almost 2 kilos of buying power, not because you spend it, not because the potatoes vanished, but just because the value of your money quietly shrank. That's the sneaky part of inflation. It's like this invisible tax eating away in your savings.
Wow. Yeah, when you put it like that. Losing nearly 2 kilos of potatoes without doing anything. It shows how even seemingly small percentages we hear about can have a real painful impact. On groceries, yes, but also on bigger things like retirement plans, everything. And this isn't just some theory or something that only happens in struggling economies, right? This is played out sometimes with devastating consequences throughout history all over the world.
Oh, absolutely. History is littered with truly shocking examples of runaway inflation. You mentioned the Weimar Republic in Germany back in the 1920s. I mean, it got so bad the currency, the mark, was losing value almost by the hour. It's not an exaggeration to say people used wheelbarrows, literally wheelbarrows piled high with cash, just to buy simple things like bread. Can you imagine the chaos? Life savings wiped out instantly, complete loss of faith in money and the government. It wasn't just an economic crisis, it was a total societal breakdown.
Yeah.
Shows how inflation can just shred the fabric of stability.
Wheelbarrows full of money for bread. It sounds surreal, almost darkly comic. But incredibly, it got even worse elsewhere, didn't it?
It did. Tragically. Look at Hungary after World War II. They experienced perhaps the most extreme hyperinflation ever recorded. Prices were doubling, not yearly, not monthly,
Right.
every 15 hours. Just try to wrap your head around that. A daily inflation rate of 200%. You wake up and everything costs 3 times what it did the day before. Saving becomes pointless. Planning is impossible. Even getting paid is almost meaningless because the money's worthless by the time you get it. It's just utter economic collapse. Survival becomes the only goal.
Unthinkable. And then, much more recently, we saw something similarly devastating, though maybe not quite that extreme, unfold in Venezuela.
Yes. Venezuela in 2019, the annual inflation rate topped 65,000%. I mean, the numbers become almost meaningless at that point, don't they? Your money essentially becomes worthless within weeks, maybe days. Forget savings. People struggle to afford basic food, medicine. It's a complete breakdown of economic stability, leading to immense human suffering, millions fleeing the country. These aren't just statistics. They represent destroyed lives, vanished middle classes, and profound regional instability.
So, okay, those are extreme examples, maybe easy to dismiss as happening over there or back then. But the point is, even powerful, supposedly stable economies aren't totally immune, right? We saw hints of this closer to home in the U.S. very recently.
That's a critical point. It
Okay.
shows this isn't just a developing world problem. Think about 2020, 2021. In response to the pandemic's economic shockwaves, the U.S. Federal Reserve massively increased the money supply. The source material highlights they printed something like 40% of all circulating dollars in just those 2 years. That's an unprecedented amount.
Right.
Now, combine that huge influx of money with supply chain issues and pent-up demand. And what did we see? We saw it contribute significantly to that 8% inflation rate in 2022. It's a clear demonstration. Even the world's reserve currency isn't immune. Monetary policy has direct, tangible consequences for everyone's purchasing power.
Right. So the big takeaway here, the real aha moment maybe, is this unseen consequence of just holding cash or keeping money in a basic savings account that pays next to nothing. It feels safe, but it's actually diminishing.
Precisely. That's the crux of it. If you're holding your money in cash, whether it's literally under the mattress or just sitting in a standard bank account earning, say, 0.1% interest while inflation is running at 5% or more, you're actively losing value every single year. It's invisible, yes. Your statement shows the same number. But what that number can actually buy in the real world is steadily shrinking. And that is the core problem that investment aims to solve. It's not just about getting rich. It's fundamentally about protecting the value you've already worked hard to earn. It's about fighting back against that silent erosion.
Okay, that sets the stage perfectly. If holding cash is a losing game due to inflation, then the only real weapon we have, the only way to fight back and actually grow, is investment. But there's a really important distinction here, isn't there, between saving and investing? People often use them interchangeably, but they're fundamentally different concepts.
Hugely different. And understanding this difference is, I think, a massive mindset shift. Saving is essential, let's be clear. You need savings for emergencies, for short-term goals. Saving preserves money. It keeps it safe, accessible, but investing grows it. It transforms it. Think about it. If you only save and never invest, we've just established you're already losing real value because of inflation, even if the number looks the same. Here's an analogy I like. Saving is like taking a seed and putting it in a safe deposit box. It protects the seed, right? But it will never, ever become a tree. Investing is like planting that seed in fertile soil, watering it, giving it sunlight. It allows the seed to grow, to become a tree that produces more seeds, more fruit. The safe deposit box preserves, but only planting allows for growth and multiplication.
I like that. The feed in the vault versus the seed in the ground. It really captures that difference between constantly having to work for your money, trading your time, your energy, versus making your money start working for you, generating income almost on its own.
Exactly. That's the goal, isn't it? True financial freedom isn't just about a high salary. The truly wealthy, the financially independent, have mastered creating passive income streams. Money that flows in while they're sleeping or on vacation or doing things they love. How do they do that? By building a portfolio of assets, things that generate income or appreciate in value over time. Stocks that pay dividends, bonds that pay interest, real estate generating rent. maybe even businesses that run without their constant involvement. This directly answers that earlier question: how can money work for you? By turning it from just a number into a productive asset that generates more wealth over time, it starts compounding, growing independently of your direct effort. That's how you free up your time.
All right, so if we want to plant those seeds, make our money work for us, where do we start? The stock exchange, the Borsa, seems like the main arena for a lot of this. But what is it exactly? It can feel intimidating, like this exclusive club.
It can seem that way from the outside, for sure, but fundamentally, the stock exchange is just a marketplace. A very sophisticated one, yes, but a marketplace nonetheless. Think of it like a giant auction. But instead of art or antiques, people are buying and selling shares. And shares are just tiny pieces of ownership in publicly listed companies. So when you buy, say, 1 share of Apple stock, you're not just getting a digital certificate. You literally become a part owner of Apple. A very, very small partner, sure, but a partner nonetheless. You own a fraction of their buildings, their patents, their future profits. That makes it much more real than just numbers on a screen, right? You're connected to actual businesses. Plus, the exchange serves a vital economic role. It lets companies raise money to grow, innovate, hire people by selling those shares to investors like us. It channels savings into productive activity.
Okay, so I become a tiny partner in Apple. How does that actually make me money? What are the main ways investors profit from owning these shares?
There are really 2 main paths to profit from stocks. The first one, the one people often think of first, is capital gain. This is simple. The price of the stock goes up after you buy it. If you buy a share for $100 and later sell it for $150, that $50 difference is your capital gain. Simple as that. This price increase can happen for lots of reasons. The company's doing well, the industry's hot, the whole market's rising. The second way, which is really attractive if you're looking for regular income, is dividends. Many established, profitable companies choose to share some of their profits directly with their shareholders. They pay out dividends, often every quarter, so you get cash payments just for holding the stock, even if you don't sell it. It's like getting rent from a property you own, but it's your share of the company's earnings.
And that potential for capital gains can be pretty dramatic sometimes, right? We hear stories.
Oh, definitely. The potential can be significant, though it's never guaranteed, of course. Let's look at Apple again. The source material mentions its stock grew about 360% over 5 years. Think about that. If you'd put in, say, 10,000 EGP, it would have grown to 46,000 EGP in just 5 years. That's a powerful example of capital gain from a major successful company.
Wow, 360%. That really drives home the potential power of just holding on to a good investment. Are there even more? Maybe explosive examples?
Well, the source uses Tesla as a really dramatic illustration. An investment of 10,000 Egyptian pounds in Tesla 5 years prior could have hypothetically ballooned to 150,000 EGP. That's a 15x return, or 1,400%. Now, that's obviously exceptional, definitely not the norm, and highlights the potential in high-growth disruptive companies. It shows how getting in relatively early on a groundbreaking company can lead to truly life-changing returns. But, and this is a huge but, past performance is absolutely no guarantee of future results. These are specific examples, and this level of return comes with significant risk.
Absolutely. Got to keep the risk in mind. And bringing it closer to home, for some listeners, the example of Fowry in Egypt is also quite striking.
Yes, Faraday stock saw a huge jump, about 6 times its value, going from around 2 EGP to 12 EGP in just 2 years, according to the source. These aren't just abstract numbers. They show the real potential for financial growth within the stock market if you make informed choices and have a bit of patience. And, speaking of professional insights and really understanding these markets, I do want to mention something important here. I want to highlight that the Shark Trading Channel, the source of much of today's material, offers incredibly specialized and professional content focused specifically on trading and investment. They actually have 7 professional courses covering everything from the basics to really advanced strategies. 2 of these advanced courses, aimed at professionals, have apparently caused quite a stir, revealing some major behind-the-scenes secrets of the financial markets. On top of that, they have 4 best-selling professional books. Honestly, this channel is a huge asset. The kind of deep dive information they provide, it's often sold for very large sums of money elsewhere. So definitely check them out. We'll put the link to their channel and resources right there in the description below the video. It's a valuable resource.
Okay, that's a great resource to know about. Now, we've talked about the exciting upside, those big potential gains. But we absolutely have to balance that discussion by acknowledging the risks, the bumps in the road. Because, let's be honest, investing isn't a one-way street to riches. The market can turn, sometimes violently. Understanding this isn't about scaring people off. It's about being realistic and prepared, right?
Couldn't agree more. It's absolutely vital. Market volatility is real. The market goes up and it goes down, sometimes gradually, sometimes sharply and unpredictably. Investments are not guaranteed. You can lose money. We need to be crystal clear about that, not to discourage investing, but to encourage intelligent investing. It's about understanding the full picture, managing expectations, and building resilience.
So give us a stark example, something that really hammers home the potential downside, the reality of capital loss.
Okay, let's look at the Amazon story from the dot-com bubble era. Back in 1999, Amazon was flying high, stock price around $113. Everyone was piling into tech stocks, euphoria was everywhere. Then the bubble burst. By 2001, just 2 years later, Amazon's stock had plummeted to about $5. Imagine you'd invested, say, 100,000 Egyptian pounds at the peak in 99, caught up in the hype. By 2001, that 100,000 would have shrunk to just 5,000 EGP. That's a devastating 95% loss. It's a brutal reminder of market risk, the danger of bubbles, and what can happen if you invest without understanding the fundamentals or getting swept up in mania. It's a powerful cautionary tale.
Ouch. Yeah, a 95% loss. That's incredibly sobering. It really drives home that point about risk. So if that's the potential downside, what's the answer? We can't just avoid investing altogether because we already know holding cash is a guaranteed loss in real terms due to inflation.
Exactly. Avoiding investment isn't the answer. That's like staying home forever because you might get into a traffic accident. The solution is knowledge. It's doing your homework before you invest. You absolutely have to study the company. What does it do? How does it make money? What are its financials? Who are its competitors? Who's running the show? And you need to understand the broader market context too. What's happening in the economy? What are the trends in that specific industry? Informed decisions are your best protection. And crucially, you need to differentiate between long-term investing and short-term speculation or trading.
Yes, the investor versus trader distinction. They sound similar, but they approach the market very differently, don't they?
Fundamentally different approaches. An investor typically is playing the long game. They're focused on the underlying strength and growth potential of a company or asset over years, maybe even decades. They do their research, believe in the value, and try not to get too fussed about the daily ups and downs. The goal is building wealth slowly, steadily, through compounding and long-term appreciation. A trader, on the other hand, is usually in it for the short term. They're trying to profit from quick price swings, maybe holding positions for days, hours, or even minutes. They often rely more on technical charts, market sentiment, quick reactions. Trading can be profitable, but it's generally much riskier, way more stressful, and demands a huge amount of skill, time, and discipline. Our focus today, the strategies we're discussing, are really geared towards that long-term investor mindset, building sustainable wealth, not chasing quick profits.
That's a really important distinction for listeners. So thinking about those long-term strategies, one of the most powerful yet surprisingly simple is dollar cost averaging, or DCA. Sounds technical, but it's more about discipline than anything else, right?
It's absolutely about discipline, and it's also a brilliant psychological tool. Dollar cost averaging, or DCA, just means investing a fixed amount of money at regular intervals. Could be weekly, monthly, whatever schedule works for you. The key is you invest that same amount regardless of what the market is doing. Market's up, you invest. Market's down, you invest. Market's flat, you still invest. Like clockwork.
Okay, so I just commit, say, 1,000 EGP every month into my chosen investment, no matter what the headlines say. Why does that actually work? It feels a bit weird to buy when prices are falling. Wouldn't I just be throwing good money after bad?
That's the counterintuitive genius of it. It works for a couple of really powerful reasons. First, the math. When prices are low, your fixed 1,000 EGP buys more shares. When prices are high, that same 1,000 EGP buys fewer shares. Over time, this automatically averages out your purchase price, often leading to a lower average cost per share than if you tried to guess the market's peaks and troughs. It smooths out the ride. Second, and maybe even more important, is the psychological benefit. It takes emotion out of the equation. Fear makes people sell low. Greed makes them buy high, usually the exact wrong things to do. DCA forces discipline. It stops you from making rash decisions based on panic or euphoria. You just stick to the plan. It automates good investing behavior over the long run.
And the long-term results of just sticking to that simple plan can be pretty astonishing, can't they? That example, comparing different ways of saving the same amount over 20 years, really highlights this.
It's a truly mind-blowing comparison, yes. Let's walk through it again because it's so impactful. Imagine saving 1,000 Egyptian pounds every month for 20 years. That's 240,000 EGP total you've put away. Option 1, you literally hide it under the mattress. After 20 years, you have 240,000 EGP. And its buying power has been shredded by inflation.
Option 2, you put it in a basic bank savings account, maybe earning a little interest. After 20 years, the source suggests you might have around 519,000 EGP. Better, but not life-changing. Option 3, you consistently invest that 1,000 EGP per month using DCA into, say, gold, as the example uses, being a traditional store of value. After 20 years, the potential outcome cited is a staggering 2 million 1,000 EGP. 2 million. Compared to 240,000 under the mattress, it just vividly shows the incredible power of consistent investing and letting your money work for you over time, even with a relatively simple strategy. It's the consistency and the asset choice that make the magic happen.
2 million versus 240,000. That difference is almost unbelievable. 1.76 million EGP more just by choosing investment over hoarding cash. And a huge driver of that difference is that other magical concept, compounding. Einstein supposedly called it the eighth wonder of the world.
He might well have, and it truly deserved that title. Compounding is the engine that drives long-term wealth creation. It's a simple idea, really. Your investment earnings, interest, dividends, gains get reinvested, and then those earnings start earning returns too. It's often called interest on interest, or the snowball effect. Unlike simple interest, which only pays on your initial amount, compounding makes your money grow exponentially because the earnings themselves become part of the earning base.
Can you break down that example again? Show how it starts small but builds momentum.
Sure. Let's say you start with 1,000 EGP and earn a 10% annual return. Pretty standard hypothetical return. Year 1. You earn 100 EGP, 10% of 1,000. Your total's now 1,100 EGP. Year 2, here's the magic. You earn 10% not just on the original 1,000, but on the full 1,100. So you earn 110 EGP. Your total is now 12,210 EGP. That extra 10 EGP, that's earnings on your earnings.
Yeah.
Year 3, you earn 10% on 12,110, which is 121 EGP. Your total is 1,331 EGP. See how the amount you earn each year increases? It starts slowly, but over time it accelerates dramatically, like that snowball rolling downhill, getting bigger and faster.
And stretched out over decades, that acceleration becomes incredibly powerful. That's where you see those huge differences we talked about.
Exactly. Let's take that 1,000 EGP monthly investment again. Over 20 years, you'd invest a total of 240,000 EGP out of your own pocket. But if that investment earns an average of 10% per year, a reasonable historical average for broad stock market investments, though not guaranteed, thanks to compounding, your total pot could grow to roughly 760,000 EGP. That's over 500,000 Egyptian pounds, 520,000 EGP, that you didn't contribute yourself. That's purely the result of your money making more money and those earnings making even more money. That's the real magic of long-term investing. Your money starts doing the heavy lifting for you.
Incredible. So time plus consistency plus compounding make a powerful wealth-building formula. But even with compounding working for you, putting everything into one single investment, even a great one, is still risky. Which brings us to another absolute bedrock principle, diversification. Don't put all your eggs in one basket.
Absolutely fundamental. Diversification is non-negotiable for prudent investing. It simply means spreading your money across different types of investments, different industries, different geographical regions. Why? To reduce risk. Simple as that. The idea is that different assets tend to react differently to economic events. If one part of your portfolio takes a hit, say tech stock slump, another part, maybe bonds or gold, might hold steady or even go up, cushioning the overall blow. It's about building a portfolio that's resilient, that can handle different economic weather conditions without collapsing.
So what might a well-diversified portfolio actually look like for an individual investor? What kind of mix are we talking about?
It varies depending on your goals, age, risk tolerance. But a common approach involves mixing asset classes. You might have some in stocks for growth potential, but not just one stock. Maybe a mix covering different sectors, tech, healthcare, consumer goods, and regions, US, Europe, emerging markets. You'd likely have some in bonds, government, or corporate bonds, which are generally less volatile than stocks and provide income. Maybe an allocation to real estate, perhaps through real estate investment trusts, or REITs, which we can talk more about. And potentially some commodities like gold, often seen as a hedge against inflation or uncertainty. The key is having assets that don't all move in perfect lockstep, so when one zigs, another might zag. There's that stark saying in finance, diversify or die. Bit dramatic, maybe, but it really underscores how critical diversification is for protecting your capital long term.
Diversify or die. Definitely memorable. It makes the point clearly. Now, for someone listening thinking, okay, buying stocks, bonds, gold, real estate, that sounds complicated and maybe expensive. There's a simpler way to achieve a lot of this diversification instantly, right? Exchange-traded funds or ETFs.
ETFs have been a complete game changer for individual investors, exactly for this reason. They make diversification incredibly easy and accessible. An ETF is basically a fund that holds a whole basket of assets. Could be stocks, bonds, commodities, whatever. But it trades on the stock exchange just like a single stock. So with one purchase, you can instantly own tiny pieces of potentially hundreds or even thousands of different securities.
And they can hold all sorts of different things,
Yeah.
not just stocks.
Oh yeah, they're incredibly versatile. You can get ETFs that track major market indexes, like the S&P 500, the US. So the source mentions VOO as a popular example, giving you exposure to 500 large US companies in one go. But you can also find ETFs focused on specific sectors, tech, energy, healthcare, you name it. There are ETFs for different countries or regions, ETFs for bonds of various types, ETFs for commodities like gold or oil, even ETFs for real estate through REITs. Pretty much any slice of the market you want exposure to, there's probably an ETF for it.
So what are the big advantages? Why have they become so popular, especially maybe for people starting out or who want that diversification without picking individual winners?
Several key advantages. First, instant diversification means lower risk compared to buying just one or two stocks. If one company in the ETF tanks, it has a much smaller impact on your overall investment. Second, they usually have very low fees, especially compared to traditional actively managed mutual funds. Fees eat into your returns over time, so low costs are a huge plus for long-term growth. More of your money works for you. Third, they're super accessible. You can buy and sell them easily throughout the trading day, just like stocks, and often you can start investing with relatively small amounts of money. So yeah, they provide a really practical, low-cost, efficient way to build a well-diversified portfolio right from the start. And speaking of practicalities, choosing the right platform is crucial. Unfortunately, there are scam platforms out there, platforms that aren't really about genuine investing. Because of that, we've looked into this and can recommend a specific platform that is safe, globally recognized, and genuinely facilitates trading and investment. It's known for being very fast and reliable when it comes to both putting money in and taking it out, which is obviously important. And as a bonus for our listeners, they're offering a 50% bonus on your first deposit, which can give your initial investment a nice boost. We've put the direct link to this secure platform right there in the description below the video for easy access.
Okay, great. So we have DCA, compounding, diversification, and ETFs as powerful tools. But zooming out again, are there broader strategies like famous portfolio models developed by financial heavyweights that individuals can learn from?
Definitely. Studying established portfolio models can give you a great framework for thinking about your own asset allocation. One of the most famous is Ray Dalio's all-weather portfolio. Dalio, the founder of Bridgewater, one of the world's largest hedge funds, designed this portfolio with one goal in mind: to perform reasonably well no matter what the economic environment is. Inflation, deflation, growth, recession. It aims for stability across all conditions. It's about resilience.
All weather, like the sound of that. Resilient in any storm. So what's actually in it? What's the mix that makes it supposedly weatherproof?
It's built on balancing different asset classes that tend to do well in different economic seasons. The typical allocation is something like 30% stocks for growth when the economy is strong, 40% long-term bonds, which tend to do well when growth slows or in deflation, 15% intermediate-term bonds, often included, adding another layer, 7.5% gold, and 7.5% broad commodities. Both golds and commodities often do well during inflationary periods or uncertainty. Correction from outline. Splitting the 15% gold and 15% commodities in outline into 7.5% each is a common interpretation refinement of the all-weather concept, though the core idea remains. The exact percentages might vary slightly depending on the interpretation, but the core idea is deep diversification across assets that thrive in different conditions. It's based on the idea that since you can't reliably predict the economic future, you build a portfolio that can handle any future by balancing these opposing forces. It might not give you the absolute highest return in a raging bull market, but it aims to protect you better during downturns.
Makes sense. Balancing assets for different economic seasons. And another big institutional model comes from Yale University, famous for its endowment success.
That's right. The Yale model, largely developed under the legendary David Swensen, who managed their endowment for decades with phenomenal results. This approach, often influencing other Ivy League portfolios, is also heavily focused on diversification, but with a stronger emphasis on achieving high long-term returns by including significant allocations to alternative assets, things beyond just traditional stocks and bonds, and a strong global focus.
Okay, so how does the Yale model differ in its components? What does that typical allocation look like?
It's generally more equity-heavy and includes more alternatives. A simplified version inspired by it might look something like maybe 20% U.S. stocks, 20% international developed market stocks, maybe 10% emerging market stocks for that global growth, 20% real estate, often through REITs for individuals, 15% bonds for stability, and perhaps 15% commodities or other alternatives like private equity, though private equity is harder for individuals to access directly. The key takeaways from the Yale model are: diversify globally, embrace equities for long-term growth, and strategically include alternative assets like real estate and commodities to potentially enhance returns and further diversify risks. While replicating it exactly is tough for individuals, the principles broad diversification, long-term view, including alternatives, are very valuable.
These are really insightful models emphasizing that diversification is key, but here's where things get, well, maybe a bit uncomfortable or surprising for people who rely on experts. When you look at the actual historical data on how professional money managers perform, the results are often not what you'd expect.
This is one of the most fascinating and, frankly, potentially paradigm-shifting findings in finance over the last few decades. It really challenges the common wisdom. Study after study has shown that a surprisingly large percentage, the source quotes 64%, and other studies show similar or even higher figures of professional, active investment managers fail to beat their benchmark index, like the S&P 500, over the long term, especially after accounting for their fees. It catches people off guard because you assume paying an expert, someone with fancy degrees and Bloomberg terminals, guarantees better results. But the evidence often suggests otherwise.
64% underperform the market. How is that even possible? These are the pros.
It seems counterintuitive, right? But there are reasons. First, markets, especially large ones like the U.S. stock market, are pretty efficient. Information gets priced in quickly. Consistently finding undervalued stocks or timing the market perfectly is incredibly difficult, even for experts. Millions of other smart people are trying to do the same thing. Second, those professionals face pressure to outperform rivals, pressure to justify their fees, which can lead to behavioral biases, like herd mentality or taking excessive risks. And third, fees. Actively managed funds charge higher fees than passive index funds or ETFs. Those fees create a significant hurdle that managers have to overcome just to match the market, let alone beat it. It's a tough game to win consistently.
So if the majority of pros can't reliably beat the market average, what does that mean for the average person listening to us? Should they just give up?
Quite the opposite. It's actually empowering information. It suggests that for many, maybe most, individual investors, a simple, low-cost, highly diversified strategy, like buying and holding a broad market index ETF, is likely to produce better results over the long run than trying to actively pick stocks or paying high fees for active management that often underperforms anyway. That study mentioned in the source. Over 15 years, the average investor just holding a broad market ETF like VOO outperformed 91% of the professionals. It highlights the power of just capturing the market's overall return, minimizing costs, and staying disciplined. Harness the market. Don't try to outsmart it constantly.
And this isn't just some academic theory. Warren Buffett, maybe the most respected investor alive, famously proved this point with a public bet, didn't he?
He absolutely did. It's a classic story. Back in 2007, Buffett made a public wager of $500,000. He bet that a simple, low-cost S&P 500 index fund, the kind anyone can buy, would outperform a selection of sophisticated hedge funds chosen by an expert manager over 10 years. A lot of people thought the hedge funds, with their complex strategies and high-paid managers, would win easily, but Buffett won decisively. Over the decade, the simple S&P 500 index fund returned 125.8%, while the hand-picked hedge funds managed only 36.3% after fees. It was a powerful real-world demonstration from the ultimate insider that for most people, passive low-cost indexing is incredibly effective. Even the giants recognize its power. And, for anyone listening who feels inspired by this, who wants to really take control and learn how to navigate these markets properly from the ground up, I should mention there's a dedicated professional course available specifically designed for teaching trading and investment from scratch. It aims to take you methodically to a professional level of understanding and competence. We've included the link for that comprehensive course right in the description below the video as well.
This has been incredibly thorough. We've gone from the threat of inflation silently eating away at savings, all the way to specific strategies, institutional models, and even the surprising truth about professional performance. So let's bring it all together. After soaking all this in, what does it mean for our listeners right here, right now? What are the absolute key takeaways and practical next steps?
I think there are two foundational takeaways. First, truly get inflation. Understand its silent, constant impact on your money's real value. It's not abstract, it's real. Once that sinks in, the second takeaway becomes obvious. Strategic investment isn't just optional for growth, It's essential for protection. It's the only reliable way to counteract inflation and make your money work for you, not against you.
Okay, so internalize the threat, recognize investment as the solution, then what? What are the concrete actions people can take based on everything we've discussed?
Let's list them out clearly. 1, as we said, truly understand inflation's impact. Let that motivate you. 2, just start. Seriously, even small. If you're totally new, maybe open a simulation or a paper trading account first. Practice buying and selling without real money just to get comfortable with the mechanics. The biggest hurdle is often just starting. Don't wait for the perfect time.
Right, overcome that initial inertia. What's next?
3, be consistent. Set up a regular monthly investment, even if it's just 500 or 1,000 EGP or equivalent. That consistency is what fuels dollar cost averaging and harnesses compounding. Make it automatic if you can. 4, diversify. Don't put everything in one place. Use those low-cost ETFs to easily spread your money across stocks, different sectors, regions, bonds, maybe some gold or REITs. Remember, diversify or die.
Consistency and diversification. Got it. And the mindset.
5, think long-term, years and decades, not days and weeks. Markets will go up and down. Expect it. Accept it. Don't panic sell during downturns if you're investing consistently. Those can actually be opportunities to buy more at lower prices. Stay the course. And finally, 6, look at those global models like Dalio's all-weather or the Yale approach. You don't have to copy them exactly, but understand their principles of balancing different assets for resilience and growth. Adapt those ideas to your own situation and goals. Use them as a guide.
That's a fantastic, actionable checklist. Now, looking ahead, we're always eager to know what complex topics you, our listeners, want us to tackle next. If there's a specific subject, a burning question, something you'd like us to give the deep dive treatment, please tell us in the comments below. Your suggestions really do guide our future explorations.
And please, don't forget about those important links we've mentioned throughout our chat today. They're all gathered in the description box. Seriously, check them out. There are links to the Shark Trading channel, the recommended trading platform, the professional course, and other resources. They offer genuine value for taking your understanding and your actions to the next level.
You know, in this world of constant flux, economic shifts, and this invisible fight against inflation, maybe the real superpower isn't just about earning more. Maybe it's about understanding how to make your money, and just as importantly, your knowledge, work tirelessly for you, generating security and freedom even while you sleep. It really makes you think. What will you do with this insight? How will you put your money and this knowledge to work starting today?
And building on that, as you mull over everything we've discussed, we want to leave you with 3 deep questions to really consider. First, how could your financial future genuinely change, maybe dramatically, if you committed to consistently applying just one of these strategies like DCA or using ETFs for diversification starting right now? Second, what hidden potential, what opportunities for growth and security might you have been missing out on by letting your money just sit there instead of actively putting it to work for you? And third, thinking practically, what is one concrete immediate step you can take today, literally today, to start protecting your wealth from inflation and begin building that more secure, more prosperous financial future?
If you found real value in this deep dive today, if it sparked some ideas or clarified some concepts, please make sure you subscribe to the channel. That way, you won't miss our next exploration into the topics that matter. And as always, you will find all the links to the source materials, the books, the courses, the platforms we talked about, everything conveniently listed right below in the description. Thanks for joining us, and I'll see you on the next deep dive.